Hey everyone, welcome back to the channel. Today I'm talking about the top 10 Canadian stocks you should consider buying heading into 2025. Whether you're after reliable dividends, impressive growth, or a mix of both, this list has something for everyone. But before we jump into the list, let's talk about one of the best tools for Canadian investors, the tax-free savings account, or TFSA. If you're not already using your TFSA to invest, you're missing out. Here's why. As long as you hold eligible investments in there, in other words, stocks which trade on major exchanges, any profits or dividends you earn in a TFSA are completely shielded from taxes. Why is this important? Well, the stocks I'm going to talk about today are perfect for TFSAs. Many of these companies pay consistent high dividend yields and their shares have strong long-term growth potential. By putting these stocks in a TFSA, you can grow your wealth faster without worrying about capital gains taxes or losing a chunk of your dividend income to taxes. It's the ultimate setup for building a solid long-term portfolio. All right, now that we've got that covered, let's get into the list. First up, let's talk about Shopify. Shopify is one of the most valuable companies on the TSX with a market cap of over $200 billion. It's a leader in the e-commerce space, helping merchants scale their businesses with tools for everything from storefronts to payment processing. The revenue growth has been massive, jumping from $2.9 billion in 2020 to over $8 billion today. And they're not stopping there. Shopify is using AI to help merchants optimize their sales with things like personalized product recommendations and automated marketing tools. If you believe in the long-term growth of online shopping, Shopify is a must-have for your portfolio. It's ideal for investors who are focused on innovation and long-term growth. Next up is Toronto Dominion Bank, or TD. Banks are the backbone of the economy, and TD stands out with a strong presence in both Canada and the US. This is a classic dividend stock with a yield of over 5%. You're getting a great payout here. To put that into perspective, if you were to invest $20,000, you'd earn $1,000 annually in dividends from this stock. And while the past year was tough for the banking sector and TD has been facing some trouble with anti-money laundering issues, it's a great time to buy it on weakness, as it's still well positioned to benefit as interest rates stabilize and business activity picks up over the long haul. If you're looking for steady income and growth from a solid financial institution, TD is one of the best options out there to consider. Next, let's move on to Enbridge. If you want consistent income, Enbridge is a name you can trust. They've raised their dividend for 30 consecutive years. That's the kind of reliability investors love. Plus, their long-term contracts ensure stable cash flow no matter what happens to oil prices. With a dividend yield of over 6%, Enbridge is a perfect option for income-focused investors who also want exposure to the energy sector. And while the world transitions to renewable energy, oil and gas are still essential, making Enbridge a key player for years to come. Next is Fortis. This utility company is the king of dividend consistency, raising its payouts for an incredible 51 straight years. Right now, it offers a yield of around 4%, and they plan to increasing it by 4 to 6% annually over the next 5 years. Fortis has a low beta of just 0.2, meaning it's much less volatile than the overall market. That makes it a great choice if you want steady returns without the stress of big price swings. If safety and stability are your priorities, Fortis is an excellent pick for the long term. Next up is BCE, one of Canada's leading telecom giants. BCE offers a jaw-dropping dividend yield of over 10%. That's rare for a company of this size. Now, they face some challenges this year, including rising interest rates and a pause in dividend growth as they focus on expanding into the US. But for patient investors, BCE's high yield and long-term potential make it worth a second look. If you're willing to wait out the short-term hurdles, BCE could pay off big time. For growth-oriented investors, Dollarama is a stock to watch. The discount retailer is expanding rapidly with plans to grow its store count from 1,600 today to 2,200 by 2034. They're also increasing their stake in Dollar City, which operates in high growth markets in Latin America. Over the past 5 years, Dollarama's stock has tripled in value, and with more expansion ahead, they show no signs of slowing down. If you're looking for a retail stock with both the domestic and international growth potential, Dollarama is a standout option. Another great growth story is Alimentation Couche-Tard. This convenience store giant operates globally with a presence in North America, Europe, and Asia. They're constantly expanding through strategic acquisitions, including a recent bid to acquire 7-Eleven. That's a massive move that could cement their dominance in the convenience store space. Couche-Tard combines stability with long-term growth potential, making a great pick for investors looking for global exposure. Next, let's talk about Air Canada. The stock is still trading well below its pre-pandemic highs, but travel demand is steadily recovering. Plus, falling oil prices could lower their operating costs, giving a nice boost to profitability. Air Canada is a bit riskier than some of the other stocks on this list, but if you're willing to ride out short-term volatility, it could be a great long-term play. With the travel industry set to rebound further, Air Canada has the potential to soar even higher. Next up, Canadian Tire. This is a household name in Canada, and it's a cornerstone of the retail sector. Their dividend yield is 4.5%, which is solid for anyone looking for reliable income. Canadian Tire has done a great job of diversifying its business over the years, from automotive to home goods to sporting equipment. They've proven they can adapt to changing market conditions, which makes them a stable option for conservative investors. Finally, we have RioCan REIT. If you want exposure to Canadian real estate without the hassle of owning property, RioCan is a fantastic choice. They offer a near 6% dividend yield, and unlike most dividend stocks, RioCan pays out monthly instead of quarterly. Their portfolio focuses on high-density, transit-oriented properties in Canada's largest cities, which are always in demand. With a mix of retail, office, and residential properties, RioCan is well positioned to deliver steady income and long-term growth. And that wraps up the list. Whether you're into high-yielding dividend stocks or stocks with strong growth potential, these 10 Canadian stocks have you covered heading into 2025 and beyond. If you like this video, please make sure to leave a like and subscribe for more. Thanks for watching.